Money, in its earliest forms, emerged as a solution to the limitations of barter systems. Bartering, or the direct exchange of goods and services, posed challenges due to the double coincidence of wants, where both parties had to desire each other's goods or services. As societies evolved, commodities such as shells, livestock, grains, and precious metals like gold and silver were adopted as mediums of exchange due to their durability, divisibility, and universal acceptance. Money serves three primary functions in modern economies: a medium of exchange, a unit of account, and a store of value. As a medium of exchange, it facilitates transactions by eliminating the need for a double coincidence of wants. As a unit of account, it provides a common measure for comparing the value of goods and services. Lastly, as a store of value, money enables individuals to save purchasing power for future use. Money exists in various forms, including commodity money, representative money, and fiat money. Commodity money derives its value from the intrinsic worth of the material it's made of, such as gold or silver coins. Representative money, on the other hand, is backed by a physical commodity but can be exchanged for that commodity. Fiat money, which is prevalent today, has no intrinsic value and is declared legal tender by governments, relying on trust and government backing for its value. In modern economies, central banks play a crucial role in controlling the money supply and regulating monetary policy. Central banks, such as the Federal Reserve in the United States or the European Central Bank, have the authority to issue currency and regulate the banking system. Through mechanisms like open market operations and reserve requirements, central banks influence the money supply to achieve macroeconomic objectives such as price stability and full employment. Commercial banks operate under a system of fractional reserve banking, wherein they only hold a fraction of their deposit liabilities as reserves. The rest of the deposits are lent out to borrowers, effectively creating new money through the process of credit creation. This system allows banks to expand the money supply and facilitate economic growth, but also poses risks such as bank runs and financial instability. With the advent of digital technologies, the concept of money has evolved beyond physical currency. Electronic money, or e-money, refers to digital representations of currency that exist purely in electronic form. Examples include debit cards, credit cards, mobile payment apps, and cryptocurrencies like Bitcoin. Electronic money offers convenience and efficiency in transactions, but also raises concerns regarding security, privacy, and regulatory oversight. The global economy relies on an international monetary system to facilitate trade and financial transactions between countries. Historically, systems such as the gold standard and the Bretton Woods system provided frameworks for international monetary exchange. Today, the international monetary system operates on a combination of floating exchange rates, managed exchange rate regimes, and international financial institutions like the International Monetary Fund, IMF. Money plays a vital role in stimulating economic activity and fostering growth. It facilitates investment by providing a means of financing and capital allocation, encourages consumption by enabling transactions, and promotes specialization and division of labor within economies. Effective monetary policies, including interest rate adjustments and quantitative easing, aim to maintain stable economic growth by managing inflation, unemployment, and overall economic stability. Inflation, the sustained increase in the general price level of goods and services over time, erodes the purchasing power of money. When the supply of money grows faster than the supply of goods and services, prices rise, reducing the real value of money. Central banks closely monitor inflation rates and adjust monetary policy to maintain price stability and preserve the purchasing power of the currency. Beyond its economic functions, money holds significant psychological and societal implications. It influences social status, power dynamics, and individual behaviors. The pursuit of wealth can drive ambition and innovation, but also lead to inequality, corruption, and social tensions. Additionally, cultural attitudes towards money vary widely, shaping societal norms and values related to work, success, and material wealth. In summary, money serves as the lifeblood of modern economies, facilitating transactions, enabling economic growth, and influencing social dynamics. Its evolution from primitive forms of exchange to complex financial systems reflects the dynamic nature of human societies and the ongoing quest for efficient means of exchange and value storage. Understanding the intricacies of money is essential for navigating the complexities of modern economies and addressing challenges related to financial stability, inequality, and economic development.